while the panel comes up, I'll just share. I don't know if this is an experience that you have. It sounds like many of us work in financial inclusion or in financial services, and every summer we have a lot of interns. And this year we have 5 or 6 interns that are coming from business schools, and we have these sessions with them where we say, like, what do you want to do? How can we help you get there? And most of them this year in our office are interested in impact investing. You know, like there are these B school students who say, oh, I want to get into impact investing. And then when I drill down and say, well, what does that mean? Like, what kind of impact are you talking here? They don't really have a great answer. Like, oh, I just want to create a better world, or I just want to use finance for social good. And so on this panel, my goal is to get a little bit more specific about what that means, to understand what some of the perspectives are from people who are doing investing. And we'll also explore some of the ecosystem factors that need to be in place to ensure success in impact investing, especially in emerging markets where things can be a little bit less stable than in high-income economies. This panel represents a broad approach to impact investing. We have one more traditional impact investor, Walter Sweet from Rockefeller Philanthropy Advisors. We have 2, if I can call them impact investors, from the multilateral space. So Matthew Saal is from the IFC, which is the private sector arm of the World Bank, and is actively involved in the investment space from the World Bank perspective. And then Sergio Navajos, over there on my right from the IDB, who has been at the MIF, the Multilateral Investment Fund at the IDB, for quite some time. And then we have Matt Homer as well, who he's sort of the person on the panel that's not like the others, because USAID is not investing for a return, but they certainly are investing in the ecosystem and paying attention to the space and making sure a lot of the infrastructure factors are in place so that the other folks on the panel can be successful in their investments. So Walter, I'd love to start with you. I called you the more traditional impact investor. I don't know if that's an oxymoron, because I wouldn't say that impact investing is traditional, but I'd love to hear about how you define impact. All investment obviously has some kind of impact. So when you, as an impact investor, are pursuing impact, what exactly are you looking for?
That's a great question. And let me first say that it's really can you hear me okay? Is this on? Okay. It's really great to be back here. Many years ago, when I was a student here, I worked for Ellie Noem, so it's nice to see you, Ellie. So it's really a pleasure to come back and talk about the kind of things that we're doing. I mean, the short answer to what do we look for in terms of impact is really dependent upon what we're trying to do. And I would say, and this is not always helpful, but it really is a bit in the eye of the beholder. I think traditionally in this space, because impact investing is defined as investing with the aim of social or environmental return, that there's a lot of space for interpretation about what that means. So from our experience and the kinds of things that we do and what we see others doing, we see a lot of, historically at least, a lot of measurement of capital flows. So if it scales and grows and that kind of thing, it must be a success. But I think at least in the world of philanthropy, that hasn't always meant that it's doing the kinds of things that you want it to do. So I think the sector has really gravitated towards thinking about, how you measure things a bit better. And there are certain standards that have come into play. I think most famously, IRIS is one. I know that Acumen and Omidyar use a thing called Lean. Now, to some degree, these are tools that wouldn't stand up to, say, maybe an academic level of rigor around assessing impact, but they do measure social progress, and they give a good sense for an impact investing concern to understand whether or not it's serving its customers well, whether or not it's serving unique customers, whether or not these customers are new to the service, those kinds of things. And those can be very useful as a proxy to point you to whether or not you're making a difference or an impact. So my organization, we've been involved in the space for a long time, and we helped incubate the Global Impact Investing Network and some of their work around IRIS and that kind of thing. So we've always felt that it's when we think about impact, or even just sort of this kind of work more generally, impact investing, we think of it as a continuum, a tool that philanthropists or investors or others can use to make a difference. I would say more generally, whenever I speak about this kind of topic, I agree with the notion that activating capital markets and market-based approaches are going to be very useful to solving, or at least addressing, some of the world's ills, because there just isn't enough charitable dollars at work, and there's kind of a lack of, I'd say, faith in government to be able to solve a lot of problems. So that kind of is sort of how we think about that.
Great. So I'd like to get a little bit more specific and ask for an example, Walter, of an investment you've been involved in, or that you see out there and you say, like, oh, that's it. That's impact investing. That's the ideal.
Sure. I mean, we've done lots of different things, but an example of an impact investment for sort of a new donor to the space might be sort of a below market rate loan to make more affordable housing available in communities that don't have as much access to that, and we've done that sort of through some of our funds. More related to kind of fintech and that kind of thing, we run a thing called the Catalyst Fund. And the Catalyst Fund is a pooled fund with resources from the Gates Foundation, from JP Morgan Chase, and it's really taking a venture capital model and it's attempting to address the problems of many fintech startups that aren't really ready for prime time in terms of testing their products, understanding whether or not they work as advertised, and kind of giving them investments. And I say the word investments because that's sort of what people that are doing this like to say, but these are grants. But they're preparing these organizations, these businesses, so that they can be ready and attractive to more traditional venture capital investors. And we have an advisory committee of mentors and others that are advising on it, that include folks like Axion Venture Capital Lab, I think, if I got that name right, and some other sort of famous names like Omidyar and so forth. But even within that, and speaking to the issue of sort of how do you think about impact, some of the criteria they're using are sort of proxies for impact. Will it scale? Does it seem innovative? These kinds of things. Those are different sorts of terminologies than you would say, like, I know people will no longer be X, which maybe is the social problem you're addressing. So these are just sort of proximate measures to get you on that road. But I do think that impact investors have a faith that these market-based approaches really can make a difference, even if we don't always have sort of a randomized controlled trial that knows that this intervention is what really made the difference.
All right. I did look up impact investing on Wikipedia a couple weeks ago when I heard I was going to be moderating this panel. And one of the things it said was that it makes a measurable social impact or something. And so I'd love to turn towards the end of this panel on to that question of measurement that you sort of brought up. But I'd like to move to Matthew, asking about the IFC experience. So IFC has a history of investing in things that have a positive impact on the world. So why is IFC focusing on DFS in its investments?
Well, thanks, Sonja, and thanks to the organizers for inviting us to participate. Indeed, IFC's been around now. We've celebrated our... All right. Better? Better?
Way better.
Indeed, IFC's been around for 60 years now, investing in the private sector in emerging markets with to serve the World Bank Group's goals of reducing poverty and increasing shared prosperity. When we look at digital financial services, that's one of the key elements to serve the goal that we have as an institution of universal financial access. World Bank set a goal a few years ago of UFA 2020, and Doug Pierce spoke yesterday about some of the progress that's been made in that direction. But as we think about bringing literally billions of people into financial services, or giving them access to financial services, and hopefully inclusion in a broad range of appropriately tailored and funded financial services, digital technology is absolutely critical. for one thing, it's about reach, right? So mobile technology in particular enables us to reach people that conventional branch networks or other distribution systems wouldn't be able to reach. And with deference to the previous speaker, I'll still talk a little bit about channels, products, and processes. We see the need for digital transformation cutting across not just those channels, the mobile money that reaches people out in the villages, but also the types of products and the processes underlying both those services and the more traditional financial services. So we're actively investing in the digital transformation of the more traditional financial service providers, because if we're going to serve billions at the bottom of the pyramid with what will essentially be low-value, high-volume products, that needs to be done with a great degree of efficiency and straight-through processing, and the only way you can do that is leverage technology. You can't make $50 loans if you've got a 5-page paper application process. That might have worked for a $5,000 loan, but you can't do it sustainably for the lower income populations and meet their needs with appropriately tailored products. So both from the perspective of investing in new technologies and innovations that can reach more people, and in the transformation of the existing, we're focused on what we can do in the DFS space.
And can you give an example of a specific investment that IFC has made in the DFS space?
We were one of the founding investors in Bcash in Bangladesh, which has become one of the biggest mobile money operators, for example.
Congratulations. That was a pretty good investment. That's a great example. Sergio, I'd love to turn to you. MIF has typically been engaged in the microfinance space in Latin America, but it's also been engaged in venture capital. And it seems like the conversation we're having this morning sits in that intersection of financial services and venture capital, and what capital can do to create that digital transformation in traditional services. So I'd love to hear a little bit more about that space and also how the IDB thinks about impact throughout the process.
Thank you very much, and thank you for the invitation. Actually, those are very important questions, and probably we need a lot of time to discuss them. The IDB and the bank, the InterAmerican Development Bank, has been working in the space of microfinance, financial inclusion for a long time. Very early in the 80s, 90s, investing only on NGOs in general that were working on social impact, let's say in a general way. And it was interesting that among those, it appeared microfinance a really important one and one of the most successful. Now we move forward to this time, and it's happening something similar. We had a group of people who were working really on microfinance, financial inclusion, with investment, with technical assistance, with other areas of other tools of support. But I think at the same time, probably in the late 90s, early 2000s, there was another group of people who were working specifically on impact investment, and actually to try to get tools as venture capital in Latin America, which was underdeveloped. And those were actually two strains of work, not completely, but separated. Now, what I think is really interesting is now when we come to DFS and what can be invested in financial services from the digital financial service point of view, we have people from this world of venture capital now funding through funds fintech. And you have another group of people who were really focusing on microfinance institution only, also trying to fund and find opportunities on fintech. And it's really exciting because one was really people specialized on one topic, which was financial institutions, and now we have the people who were really specialized on startups, also trying to get into fintech. Actually, we were reviewing our portfolio of venture capital investment, and out of all the funds that we have, we found around 55 fintech startups funded indirectly by us. So that's like it's a new dynamic that I think is really, really important. And we probably both our areas of expertise need to be cultivated. And I don't think there's enough yet cross-cultivation in Latin America. And maybe the last comment I wanted to make is, interestingly enough, we just did a study of what's happening in Latin America in terms of fintechs. Where is fintech booming? Where are the new fintechs appearing? And most of them, around 90%, are appearing in Brazil, Mexico, Argentina, Colombia, and Chile, in 5 countries. And of course, they have been just founded since 2014. Interestingly enough, other very important markets in microfinance are not in the top of the list, which is Bolivia, Ecuador, and other countries. And it calls my attention to see why this dynamic is. And I have some ideas why this could be happening. But it's interesting to put both things together and understand how both two forces can improve financial inclusion.
Okay, you can't tell me you have ideas and then not share one of your hypotheses for why that's happening. That's fascinating, that spaces where the traditional microfinance has really been successful are not places where there's a lot of fintech innovation. And it seems like those things are related. Would love to hear your hypotheses.
Yeah, well, this is a hypothesis, of course, but in most of the countries in which microfinance boomed in Latin America were those places in which you could actually hire very highly skilled loan officers in a reasonable price, and you could actually do that. And then at the same time, in the countries in which technology is booming is where microfinance institutions were having a hard time to get a skilled worker for microfinance. And so the incentives are really, really there to get into the game into those countries with technology. And I think it's going to evolve, but the incentives are really, really ready in countries where microfinance has not been able to attract enough loan officers, enough people to work in a labor-intensive world. And now, so I think that's part of the explanation. No?
So it's a workforce issue, you think?
There are a lot of other things too. Also, it is internet. Internet is not, I know we were talking about the importance of online platform, and really important, and I think that we're living in that economy, but in a lot of poor countries in Latin America, internet is not widespread just yet. There are a lot of feature phones. So we have to see which are the limitations of these technologies. Maybe it's urban right now, and we need to get rural first with other tools.
And Sergio would probably say, this is the opinion of Sergio Navajos, not the official opinion of the IDB, whatever. Anyway.
Yeah, exactly. Exactly. Thank you.
Okay, Matt, we just heard a little bit about differences in the environment in which innovation happens from Sergio and what that looks like in the Latin America context. We heard yesterday about the merchant acceptance environment and some of the work that USAID has been doing there. It seems to me like places where investments in innovation that have some sort of social or environmental impact would be more successful in countries where there are other things in place. Can you tell me a little bit about how USAID is engaging in those other things, those ecosystem factors?
Sure, yeah, no, thank you. And I think, thank you also for mentioning, I think as you correctly pointed out at the beginning, I mean, USAID, I think, does represent sort of a different perspective because we don't do equity investments, but we do provide financial support to financial institutions and startups in this space through grants and contracts and loan guarantees. Just as a couple of examples, we have a program called Development Innovation Ventures, which provides grants to startups. We also, on the loan guarantee side, as an example, we're in the process of doing a loan guarantee with a digital lender in India. That's a very sort of new company to help them lend to merchants with no transaction history whatsoever. Right now, they're lending to merchants that have 6 months of digital transaction history. So we're helping to sort of de-risk them going to merchants without that amount of transaction history. But I think the point I want to make is that as we're thinking about impact investment and we're thinking about supporting startups and building a vibrant, inclusive digital finance ecosystem, we also need to keep in mind the infrastructure piece of this, right? And that startups will be successful in this space to the extent that the underlying infrastructure enables that or supports that. So even if you think about a company like Venmo, which probably many of the people in the room use, it still uses the ACH network, right? Which is in need of improvements, right? As we talked about a little bit yesterday. So this underlying infrastructure piece is very important. And it could be the payment system, it could be the last mile acceptance network, as we talked about a little bit yesterday. But I think another piece of it, which may not be so immediately apparent, is also the regulatory aspect, right? And that you need an enabling regulatory environment, which merits its own type of investment, which is different than an equity investment, obviously, but an important investment nonetheless. So Just to maybe say a little bit about what I mean there, as we're seeing digital finance and fintech take off in markets, that stretches, I think, the traditional capacities of regulators to oversee and supervise those markets. As the companies that are participating in this space are more technology savvy, including companies like telcos, it really requires regulators to think differently about how they supervise those markets. So USAID with RPA and with some other organizations came together to start something we're calling the RegTech for Regulators Accelerator Program, which is focused on bringing regulators together with innovators and helping innovators solve problems facing regulators. And I think that's the example of how different types of investors can come together to solve problems at the infrastructure, more foundational level that are really needed for startups in this space to be successful.
I just want to point out that we're called RPA often, so that's what it was referencing.
Yeah, so Walter, could you just jump in and tell me, when you are looking at an investment or evaluating it, are you looking for anything specific on the regulatory front? Like, I'm looking for a regulator that's not fill in the blank, or a regulator that is fill in the blank.
In inside the United States, I would say that's typically not something that we pay as much attention to. But obviously, in certain sorts of regions throughout the world, it's an item where we have to be aware of the fact. I mean, our experience is that some of the regulatory bodies just aren't savvy about some of the innovations that are coming down the pike. And so, one of the things that because of that, we've been very excited about our partnership with USAID around this to really try to accelerate their ability to deal with these things so that they can be smarter regulators and that kind of stuff. I know many people in the room have had experience with these kinds of bodies throughout the world, and it's really striking to them when you encounter them and how they maybe not prepared for past innovations. Never mind sort of some of the stuff that's coming down the pike. So I think it's very important. I think with any of these kinds of investments, if you're examining them with really looking for return, you have to sort of understand better the ecosystem from which this business, even an impact investment or grantee, if you're making a grant, really operate. And so I think any savvy grant maker or impact investor should be aware of that. And if you don't have the expertise or skill, there are ways to get it, and there are ways to talk to people that understand those kinds of things, including folks on this panel.
Mm-hmm. Okay, let me turn to Matthew again. Matthew, let's say you are making an investment in a market where there isn't a high regulatory capacity, and a lot of things happen in the financial space that the regulator just can't watch or supervise. How do you ensure that your investments are going towards responsible institutions?
Due diligence. There's no substitute for getting to know our clients and understand their business models and what they're aiming at. We tend to focus on specific markets which have a developmental need. We focus on specific types of businesses where we think that there's going to be an impact on those needs. So we have, in a sense, a starting hypothesis that in a particular market there's a need for SME finance, for example, and that certain types of business of companies or innovations might help to fill that gap. But then it's really about the due diligence that we do as an investor to understand and to make sure that this is being done responsibly. Fundamentally, if you think back to what I said earlier about bringing a couple of billion people into formal financial services, that means we're bringing a bunch of newbies into the market who may not fully understand or certainly have little experience of formal financial services. And we're doing this remotely using technology, so there isn't the same kind of face-to-face interaction that these people might have had if they had access to the microfinance loan officer who was pedaling out to the village. So the onus of making sure that the customer understands that the finance is done responsibly becomes that much greater and falls on the service provider and falls on us as an investor to both ex ante study what's being done and understand how it's being done, and also in our involvement, in our continued engagement, to be involved in governance, to be involved in helping that service provider to adhere to and constantly up the ante on the standards that it adheres to.
So I loved your example at the beginning about the 5 pages. And when you have a loan of $50 US, it would be absurd to ask a customer to review 5 printed pages of terms and conditions. Can you tell me what responsibility would look like in that context for something that's informing the customer about what they're taking on, but also not arduous?
Well, in that previous example, I was really more talking about the loan officer, right? Because for the bank to sustainably give that loan, the education piece is a challenge, and we're looking at it in terms of what kinds of information can be provided using the channels that are available, using text messaging, but financial literacy is a key challenge in some of these contexts.
So would a text message that says you just took out a loan of this much, you're going to need to repay this much, this is what the interest rate is, like all the disclosure stuff, is that a responsible way to shift to a digital delivery?
It's a start, and it's something that we're grappling with really real time. There's a couple of initiatives, the Smart Campaign for one, looking at creating standards for responsible finance that can be accepted by the investor community as well as the lending community. But we don't always know how well this is understood on the other end. And we do have a situation in Kenya, for example, where there's several 100,000 people who are blacklisted in the credit bureau for relatively small loans that they took out. Now, some of them may have actually intended to run away with it, and some of them may not have really understood the context of what that meant and but on the other hand, if we put a disclosure in that says, put up the APR, has to be posted on your branch, on the wall, wherever. Do your microfinance clients really know what an APR is versus I'm getting 100 this week, I need to pay 105 next week?
Sergio, do you want to respond to that? And what does it look like in the digital space as you are making your investments?
Yeah, I think what we have to do is more, I agree, more than the transparency. We need transparency and try to get to know exactly what clients would take. So I think it goes both ways. Also understanding what type of instrument they use to approach communication, what type of instrument they approach to get to bank. But if you don't mind, I want to make one comment about regulation. I think, of course, that's really, really important. But one of the things that I think that might confuse people is when we talk to regulators or institutions or policymakers, we have to clearly differentiate between what are emerging technologies, which is an important topic and it's coming up really, really strong, of course, and also the discussion of organization and institutionality with new actors. Because one of the things that has happened in Latin America is that once you have a new platform, once you have a new type of financial service provider, at the beginning, it can work not under the normal banking law, but the moment it grows a little, it has to go under some type of regulation. It's natural. And what has happened is that right now there are a lot of countries that are looking into crowdfunding laws, and probably the first fintech law is going to come up in Mexico very soon, which includes more than crowdfunding. But I think we have to go and start dialogue with regulators in both things. It's important, the technology, the fintech, but also what type of institutionality we are offering to the DFS providers.
But it's important as we do that to stress a certain amount of flexibility.
Yeah.
There will always be innovations that come ahead of where the regulator is. And while we should encourage the regulators to catch up, we should also encourage them to think flexibly about the way that innovations come into their market and not always be restricting it until they catch up.
No. Yeah.
I'm going to turn to questions from you all in just a minute. And I think this is totally unfair because we only just started this panel like 2 minutes ago. I just would like to have that noted for the webcast and the organizers. But I have one more question for the panel before I turn to you all. And we've covered the environment in which investments are made, due diligence, early stage grants to get a company to the investment stage. But what happens after an investment is made? How do you ensure that the company continues to be socially responsible, or continues to produce impact, or continues to focus on those things that made you invest in them in the first place? So what does that look like, keeping them accountable, and is mission drift something that is a concern? This is something that any of you could answer, so whoever wants to lean forward, please feel free to venture a response.
I'll be brief, but I would just say, as with grant making or impact investing, there are no guarantees. So that's why there's such a front load of due diligence and evaluation of who you're partnering with, because there's always an element of trust once you give over money. Having said that, the tools that have been developed, things like Iris and Lean and the rest of these kinds of things, which are essentially almost like process evaluations to some degree, like that they're measuring sort of how things are going, and they allow for sort of adjustments to business practice and other things like that as the technologies are implemented, or whatever you're doing. So I think those are ways to kind of get at that. And clearly, if you're an experienced venture capitalist, you control a lot of what you invest in. So you can make adjustments that way too.
I agree. It's a lot of it is what you do up front. Look, if Bcash decided that their next target market was going to be Japan, that would be a mission drift again, away from the development impact that we looked for. We don't think that's extremely likely given the type of business it is. That's why we chose it.
Mm-hmm. Yeah, so making sure you invest in the right companies up front. Yeah, great.
But we have a board seat, so
yeah,
if there is drift, it's a challenge. It's a challenge with fintech or any new technology, because on the one hand, you want the entrepreneurs to be flexible and to pivot when necessary, which means they may ultimately move off of what was the initial target to something else. But that's why you want to be involved as an investor, potentially with a board voice and an ability to balance whether or not the continued activity in the target market might be enhanced by their ability to be more profitable through something of a pivot versus staying, and focusing on what was the initial target if there is indeed a need for change.
All right, any questions from you all? I see a lot of hands, so I'll let the microphone folks decide. We'll take 3 questions and then we'll respond. Veronica.
Hi, thank you for this wonderful panel. I have a couple of questions. One is do you think that impact investment is related with achieving financial inclusion goals? And if there are other type of social or impact goals that you see within your investments? And then what do you think, like, if you think, like, for example, financing crowdfunding companies would be also within the scope of impact investment according to your companies? Thank you.
Yeah, so that's that question of what defines impact again, and the goals of impact. We have a question over here.
Yes, I'm Heather Hudson from the University of Alaska and Farm Radio International, and also a researcher. And I want to follow up on that evaluation and impact question because, we heard I think one approach from the IFC, which is the financial approach, put somebody on the board and then you can influence perhaps, or at least recommend to the venture going forward. But the others, in fact, we heard about, in some cases the model is more like grants, and in all senses they're related in some ways to what or what development organizations traditionally do. So I'm interested in knowing, yes, how do you go about evaluating? There's one, here's a successful entity. That's one set of metrics from the financial community, but from development agencies, what are you looking for, and how do you convince your own people internally what to invest in? Thank you.
Thanks, and you could just pass it right across the aisle. I think there was another question over here.
Hi, my name's Karen. I'm working on a financial literacy startup for parents to help teach their kids about money. We're talking about impact, and I think Matt's kind of the only one that talked about education. So I'm curious to hear from the rest of you, and Matt, of course, what other things you guys are seeing in the market in terms of efforts to educate everybody to grow up to be kind of more financially literate so they can make use of all these products you're funding.
Great, thanks, Karen. We'll take those three questions in the order that they were asked. So the first one was Veronica's question about what does impact mean. So I think we sort of naturally talk about financial inclusion because that's an easy one to talk about. But Walter, you also mentioned broader social goals and environmental goals. So Walter, I'd love to kick that question to you.
What, the specific question you're kicking to me is which one?
It was the first question
Okay.
from Veronica about what do you mean by impact, basically? And she also asked for the IFC perspective too.
Let me say this, and I hope this kind of points to what you're talking about. The folks that are funding or investing in this community accept as a given that it's a good thing if people become more financially involved in the system. So that's a given. It's part of their, the buzzword would be a theory of change, if you will.
There is some data and evidence going back many
Sure,
years about that.
sure. But I'm saying that that's sort of the given in terms of what they think. So therefore, they think if you can get more uptick in there and address sort of unbanked poor, then you'll have a social good that comes out of that. So therefore, it gets you down to the organizational kind of level of thinking about how you assess it. And that points to when I was mentioning sort of some of the tools that are being used for that, which are sort of progress indicator kind of things. And they can be surveys that are done on SMS, they could be surveys that are done in person, those kinds of things to sort of see how people experience whatever it is the financial technology is that you're delivering. And whether or not it's having a positive impact based upon the information that you're collecting. Now, there could be some data issues with that, but you're trying to use that information to make adjustments to really understand whether or not you're making the change that you thought you were going to make through the idea, through meeting with the entrepreneur, and that entrepreneur telling you, by my doing this, I'm going to change the lives of these low-income people in this way. That kind of stuff, and be able to scale this kind of intervention. So you want to be able to verify whether or not that's really happening alongside your financial returns. You can see whether or not it's scaling and becoming profitable. That's kind of an easier thing to measure. So you want to have other ways of understanding whether or not you are making a difference in the communities, which is the whole purpose for doing it in the first place.
So Matthew, you're leaning forward and about to say something. And
will.
if I could add a question to whatever you're about to say, there's Bcash and there are payday lenders, and they're both including people in the financial system, doing financial inclusion in some sense. People are using more formal services. So with whatever you're about to say, how do you distinguish positive social impact between those two institutions?
I'll distinguish further. There's payday lenders and payroll lenders. In terms of impact, look, there's lots of different dimensions of impact. For the particular subject here and the digital financial services, universal financial access, financial inclusion is a key area that we're looking at. In other work that IFC does, we're looking at creating jobs more directly through building productive facilities. In other areas, we're building infrastructure to enable greater connectivity across or within countries. We've recognized that environmental degradation contributes to poverty, and so we have programs for green technology or environmentally sound lending and so on. So there are lots of different types of impact that we as an organization look to. In terms of why we're focused on digital financial services, a big piece of it is about financial access, which, as well pointed out, is a piece of or is accepted as an element of poverty alleviation. But it's also about building out the financial services system more broadly, and that puts resources into the economy that can be reinvested and create jobs. So there's a number of different types of impact that we might look to. And in any given project, we'll have a sense of what it is that we could potentially affect, and an attempt to measure that over time through the life of the project. In terms of the the specifics around different types of lending models, I would say that we have a bunch of different verticals that we look at in the financial services space: payments, lending, alternative credit scoring, remittances, SME finance, insurtech. And so each one has its own sets of issues around it, potential channels for impact, and also the kinds of concerns that we would have in terms of responsible finance. When we look at payday lending or payroll lending, and a couple of different distinctions there. It's very important to look for levels of indebtedness and how this contributes, and also for many of these, the relationship between fees and the effective APRs that the fee versus interest rate can result in, and the way that rollovers are handled can become an important piece of preventing a cycle of indebtedness.
Can I say one quick thing?
Sure.
If you're interested in how data is collected, what is thought about, what are the considerations, the constraints, that kind of stuff, Acumen Fund and Root Capital have some good publications about that. It really sort of in detailed information about how you should approach this, their best practices from their experience and that kind of thing.
Great. So that question about grants, how do you assess the success of grants? I'd love to ask that to Matt and Sergio.
Yeah, I mean, I think one thing I would say too about, how we make sure that organizations are behaving responsibly or sort of achieving the social impact we want. With grants, your maximum point of leverage is always before the funds are dispersed, right? And after the funds are dispersed, your leverage goes down substantially. So, I mean, one way of doing that is to create multiple disbursements, right? Rather than having one large lump sum disbursement, you disperse the funds in tranches, and then that gives you the opportunity to have checkpoints. I think it's important to note that there are a variety of principles that have emerged in this space around what responsible behavior means in the context of financial inclusion. Yesterday, we heard about the G20's high-level principles for digital financial inclusion. The Better Than Cash Alliance has principles for responsible digital payments. There's Accion's SMART campaign, as we know. There's also a set of principles for digital payments in humanitarian response settings, which is a pretty unique type of setting, right? And requires thinking very carefully about how you do that responsibly when you're talking about refugees. So I think one thing that we're thinking about internally at USAID very closely is how do we take sort of these emerging principles and best practices and embed them into the way that we make decisions. And this is particularly important for us because we're a very decentralized agency, and so decisions around these type of investments or grants are not always made by people who have expertise in that specific area. So we're thinking, can we have a set of minimum standards or a set of a checklist of sort of questions that dig a little bit deeper beyond traditional due diligence to really understand, as it relates to fintech and financial inclusion, is this a company that is, or an organization that is contributing toward long-lasting, inclusive marketplace? So, one issue we've talked about yesterday and today is the agent network. And of course, one question there is there adequate liquidity, right, at the point of agents? And so those are the type of factors we want to be thinking more about as we make decisions.
Just to interject, last week at the SME Finance Forum with the CDC we kicked off a working group on translating those high-level principles into specific approaches for investing, and we'd welcome your participation and other investors who may be in the room.
Great. Sergio, anything to add on that?
Well, any grant that we give has a specific objective, and the two ways to manage that is performance-based and tranches, as it was said. But the only thing that I wanted to add is that in several topics it's important to put minimum standards, and the one that we don't talk too much here because we're talking about technology is corporate governance. That's really, really important. It doesn't matter how good is technology if you don't have the basic corporate governance. Basic corporate governance established, then you have problems. Probably that's the most important one, and then we have to go from there. But we are in the same search as Matt in looking and trying to embed other principles in our due diligence.
Great. Well, we are nearly out of time. Karen, I'm so sorry I didn't get to your question, but I'll leave it to you to connect with Walter to see if he can give you some funding for. But I loved that question about what's the landscape of funding for financial capability and financial education, and I think that's an important question. So I'm hoping we can cover it in the next break. But I'd just like to do one more rapid-fire question, so we hear from all of you on one DFS technology that you would jump at the chance to invest in if you personally were investing your funds. So you're not speaking as yourself from your institution, but you personally, what would you invest in? Rapid fire, Matthew, go ahead.
We think less about technologies per se than business opportunities and entrepreneurs. So find me somebody who's really going to solve the SME finance problem well in an emerging market with low levels of data and poor regulatory enforcement. Yeah.
Wait, I hope there's some MBA students in the room who can who can do that. Walter?
I think I'm supposed to say blockchain and quantum physics, right?
Sergio?
Yeah, a business-to-business solution for identity for banks, for incumbent banks.
That's great. And I think BankQ is in the room too. We'll hear from them later on. Shali's back there. Matt?
So this may sound very narrow and specific, so hear me out, but I think that there's an opportunity to completely reimagine regulation, and I think that increasingly there's an opportunity for consumers themselves to be the eyes and ears of regulators in markets. So I would love to see tools that enable consumers to sort of report directly to regulators around practices they're seeing in the marketplace.
I love that. Thank you, everyone. You heard it here first. Let's give them a round of applause.
Thanks, Sonja.